The American housing frenzy that once felt unstoppable is now beginning to show real fractures, not just in individual cities, but across whole states. After years of aggressive buying, relentless construction, and home prices shooting to record heights, the momentum is slipping. What we're seeing now is a shift. Listings are piling up, affordability has fallen off a cliff, and mortgage rates remain stubbornly elevated, squeezing buyers from every angle. States that were previously viewed as stable and low risk are suddenly looking vulnerable. In this breakdown, we're going to uncover the 10 U.S. states most likely to see meaningful price declines by 2026. We'll look closely at the structural weaknesses behind each one, from shaky job markets and building gluts to population changes, surging insurance premiums, and rising tax burdens. These forces aren't hitting in isolation. They're combining into a powerful pressure wave that could redraw the housing landscape nationwide. Whether you already own property, you're on the hunt for a home, or you're exploring real estate investments, the information ahead affects your decisions right now. Make sure to subscribe to Discover the Cities for straightforward, data-focused insights on where the housing market is truly headed and the key warning signs to watch. Because when entire state markets begin to wobble, no individual city is immune. All right, let's get started. Number 10. Florida. Florida has always felt like a real estate machine that couldn't be stopped. Sunshine, warm winters, and a steady stream of newcomers turned it into the nation's relocation hotspot. For years, it looked untouchable, a state where growth felt guaranteed. But under the bright skies of 2025, reality is catching up. The very momentum that once fueled Florida is now becoming its biggest challenge. The state is grappling with a crisis few saw coming this quickly: soaring insurance costs. Homeowners aren't just seeing increases, they're watching premiums explode. In the span of just 2 years, average insurance rates across Florida have jumped nearly 40%. In some coastal regions, a simple family home now carries an insurance bill that can top $10,000 a year. Windstorm coverage, flood protection, hurricane deductibles, each layer has turned protecting a property into a luxury. For many households, the mortgage is no longer the most painful payment. Insurance has taken that title. At the same time, builders kept pushing forward, convinced that demand would never run dry. But now, supply is outpacing buyers. Inventory is swelling, from Tampa and Miami to Cape Coral and Palm Coast. Developers offering incentives and discounts still watch deals crumble the moment a buyer receives their insurance quote. The idea of affordable Florida living, the dream that pulled millions south, is slipping away. Even lifelong Floridians are rethinking their routes. Some are selling while they still can and relocating inland. Others are leaving the state completely, escaping a cost crisis that no one can control. Florida's state-run insurer, Citizens, is stretched thin, and private insurers continue to exit the market. When insurance becomes uncertain, homeownership becomes fragile, and that's the reality now settling in. And yet, Florida maintains its allure. That's the contradiction. The beaches are still stunning, palm trees still line the streets, and sunset skies still turn gold every evening. The state is beautiful, undeniably so. But beneath that postcard charm, a financial storm is gaining strength. If insurance costs keep skyrocketing and buyers continue to hesitate, Florida could see home prices fall another 10 to 12% by 2026. For a deeper look into what's really happening behind the marketing slogans and glossy photos, and to understand the risks shaping Florida's future, make sure you're subscribed to Discover the Cities. Paradise hasn't disappeared, it's just become a lot more expensive to hold on to. Number 9. Arizona. For a long time, Arizona looked unstoppable. It felt like one of the few places in America where the future was wide open, endless sunshine, cheap land, and room to build for miles. People poured in by the thousands, especially from California, Texas, and the Midwest, chasing lower prices and a fresh start under desert skies. Phoenix exploded, Tucson expanded, and new suburbs like Queen Creek and Goodyear seemed to sprout overnight. Construction cranes were everywhere, each one promising growth without limits. But by 2025, that story started to change, and not gently. Water, the one resource everyone assumed would always be available somehow, is now at the center of every real estate conversation. The Colorado River keeps shrinking, and as it does, the state is being forced to rethink what development can look like. Entire master-planned communities, once confidently announced, are being delayed or quietly canceled. Land that once felt like an endless frontier suddenly comes with question marks. And with zoning tightening and building costs rising, the rush of new homes has slowed dramatically. Meanwhile, the market itself has cooled, especially at the top. Home prices have already fallen roughly 12% from their peak, and luxury areas and investor-heavy neighborhoods have taken even larger hits. The remote work boom that once turbocharged Phoenix wasn't permanent. Many of those buyers who fueled the frenzy have either gone back home or shifted to even cheaper states now that office demands have returned. On top of that, day-to-day living isn't as inexpensive as it used to be. Keeping a house comfortable in triple-digit heat was never cheap, but record-breaking summer temperatures are pushing energy bills to new extremes. Add in rising property taxes and maintenance costs, and the affordability edge that made Arizona so attractive has weakened significantly. And yet, the desert still calls. There's a reason people fell in love with this place. The sunsets still set the mountains on fire with color, and the sense of space and freedom you feel here is hard to match anywhere else. But beauty doesn't erase economic reality. With buyer demand slipping, inventory swelling, and environmental risks growing more visible, Arizona's housing market is standing on unstable ground. If current trends continue, the state could face an additional 12 to 15% price drop by 2026. Number 8. Nevada. Nevada's boom felt almost electric. For a moment in time, the state embodied the rebound fantasy. Growth, excitement, and the belief that the good times would just keep rolling. Las Vegas especially became a symbol of explosive post-pandemic prosperity. Tower cranes crowded the skyline, new luxury resorts rose along the Strip, and endless master-planned communities pushed farther into the desert. Investors, big and small, swarmed the state, convinced Nevada was the next long-term gold mine. And up north, Reno shook off its sleepy reputation, evolving into a tech-focused hub tied to Silicon Valley optimism and booming logistics. For a while, everything pointed up. It seemed like Nevada had found a formula no one could break, but by 2025, that momentum began to slow, and the shift is becoming harder to ignore. Population growth, once Nevada's greatest engine, has cooled dramatically. The feverish speculative buying that pushed prices into the stratosphere is fading. Mortgage rates remain high, insurance premiums have jumped, and suddenly, the pool of eager buyers isn't as deep as it once was. Signs of stress are showing. Foreclosures, nearly unheard of during the frenzy, are quietly ticking up, especially in sprawling suburban pockets around Henderson and North Las Vegas. Homes that used to spark bidding wars now sit untouched for weeks. Price reductions, once rare, are becoming routine. Living costs aren't helping either. Electricity bills, property taxes, HOA dues, all have climbed, eating away at the affordability that once made Nevada a no-brainer for relocation. Investors who rushed in at the peak are pulling back, leaving behind inventory they can't move and projects that no longer pencil out. And in Reno, the slowdown feels especially sharp. The tech influx that once fueled its renaissance has lost momentum. Hiring freezes, stalled expansion plans, and cooling relocation pipelines are leaving builders scrambling. The same developers who once boasted waiting lists are now throwing in incentives, upgrades, and closing credits just to get contracts signed. No one is saying Nevada's housing market will crash overnight, but the correction is already in motion. Analysts expect prices could slip another 15 to 20% before leveling off. Yet even with the market recalibrating, Nevada still holds magnetism. The desert sunset still glows gold. Las Vegas still pulses with energy and opportunity. And the absence of state income tax, that continues to attract entrepreneurs, retirees, and dream chasers alike. But the numbers don't lie. The state that bet big on endless growth is finding that even the hottest streak cools eventually. And now Nevada is holding a hand that demands discipline, not optimism. If you want to follow how this adjustment unfolds from the neon buzz of Vegas to the high desert peaks around Reno, stay tuned to discover the cities. Nevada is entering its most challenging chapter yet, and the stakes have never been higher. Number 7. Texas. For a long time, Texas stood as the poster child of the American housing miracle. With no state income tax, booming industries, and land that seemed limitless, the state pulled in families, entrepreneurs, and corporations by the hundreds of thousands. Austin's buzzing tech scene, Dallas-Fort Worth's vast new suburbs, the expanding energy corridors near Houston, and the steady growth in San Antonio all fueled the belief that Texas was the future. Affordable, thriving, and wide open for anyone ready to build a life. But heading into 2025, the shine is starting to dull. The very forces that made Texas so appealing are now revealing the challenges that come with runaway expansion. Builders race to keep up with the population surge, carpeting the landscape with developments from Frisco to Pflugerville to Katy and beyond. Yet, many of those once coveted new homes now sit vacant. Inventory in key metros has doubled since 2023, and price cuts once unthinkable during bidding war days are becoming standard. The market that once heavily favored sellers is quietly leaning back toward buyers, and the cost picture isn't what it used to be. Property taxes, already some of the highest in the country, continue to climb. Home insurance costs have jumped too, especially in areas frequently hit by hurricanes, hail, or flash flooding. Even energy bills, historically Texas' competitive edge, have crept upward. The dream of affordable Texas living is starting to feel more like a slogan from another era, as homeowners juggle rising expenses against slower wage growth. Austin, once the crown jewel of tech relocation, has already seen values fall more than 15% from their peak. Suburban Houston communities are undergoing similar pullbacks. In Dallas-Fort Worth, builders are sweetening deals with mortgage rate buydowns, upgrades, and closing incentives simply to keep sales moving. Texas still leads the nation in population growth and business expansion, but growth always comes with a bill. Roads, utilities, water systems, and public services are feeling the strain, and the state's unique promise, low taxes, big opportunity, becomes harder to maintain as the population climbs and infrastructure demands mount. If migration slows even modestly, analysts caution that home prices could slip another 15 to 18% before finding a stable floor. The Texas dream isn't gone, it's simply entering a new phase. The state remains full of opportunity, innovation, and ambition. But the idea that it could grow forever without friction is fading. Now buyers and residents are learning what happens when expansion outpaces affordability and when a booming frontier economy begins to mature. Number 6. Georgia. Georgia's rise over the last decade has been remarkable. Atlanta transformed into the engine of the modern South, a powerhouse for film production, logistics, technology, and finance. Sleek midtown skyscrapers rose alongside suburban neighborhoods stretching out through Marietta, McDonough, and beyond. For years, it seemed as if nothing could slow the state's climb. But stepping into 2025, the momentum has begun to ease, and fault lines are becoming visible beneath the surface. Metro Atlanta's for-sale inventory has surged, jumping over 40% in just 12 months. Homes that once sparked bidding wars are now sitting on the market, sometimes for weeks at a time. Rents have stopped climbing, investor activity has cooled, and developers are scrambling to keep deals afloat by offering upgrades, rate buydowns, and closing incentives. The strain isn't just about buyer demand, it's about affordability hitting a wall. Property taxes have crept up, insurance premiums continue to climb, gas costs add weight to long commutes, and for many first-time buyers, the monthly payment required to live in Atlanta no longer aligns with their income. They may love the lifestyle, the culture, the opportunity, but the cost of participating in that lifestyle keeps rising. Suburban counties that once symbolized Georgia's endless outward push, places like Henry, Cherokee, and Fayette, are seeing inventory stack up and construction timelines quietly stretch out. New houses that were snapped up before drywall went in are now staying on the market, waiting for cautious buyers. Meanwhile, inside the city, condo towers have units sitting dark as urban buyers hesitate, reassessing budgets and priorities. Atlanta's economy still looks strong on paper, but a key imbalance lingers. Job growth has continued, yet wages aren't keeping pace with inflation. That mismatch is nudging the housing market into correction territory. Analysts warn that if current patterns persist, home prices across the state could soften another 14 to 17% by 2026. But this isn't a story of collapse, it's a story of recalibration. Georgia still boasts a diverse economy, cultural depth, and a magnetic energy that attracts talent and investment. What we're seeing now is not the end of its expansion, but a reset after years of rapid acceleration. The Peach State is adjusting, not falling apart. Number 5. Idaho. For a brief moment, Idaho was the crown jewel of the remote work era, the place everyone talked about when they imagined a life beyond crowded coastlines. When Zoom calls replaced office hallways, Boise became the poster child of the Zoomtown boom. What had been a quiet, affordable mountain city suddenly found itself at the center of America's housing frenzy. From 2020 to 2022, families poured in from California and beyond, chasing blue skies, open land, and space to breathe. Homes that once sat unnoticed for months were suddenly at the center of bidding wars. In just 2 years, prices shot up nearly 50%, transforming Idaho from a hidden gem into one of the nation's hottest real estate markets. For a while, it felt like nothing could slow the momentum. But by 2025, the tide has shifted. As companies called employees back to the office and remote work flexibility faded, demand softened. Mortgage rates climbed, stretching budgets even further. And wages in Idaho simply never caught up to the runaway home values created during the boom. In Ada County, the heart of the surge, housing inventory has tripled since 2022. Streets once packed with moving vans are now lined with for sale signs. In brand new subdivisions, half-built houses and vacant lots sit quiet, visual reminders of expectations that outpaced reality. Home values have already fallen between 18% and 22%, and housing analysts warn the adjustment isn't finished yet. Developers are feeling the pressure firsthand. Construction financing is tightening. Buyers are walking away from contracts. Incentives, price cuts, and closing bonuses are becoming standard as builders scramble to stay afloat. Some projects have been abandoned altogether. Investors who bought at peak pricing are absorbing losses, while renters, once desperate for a place to live, now see plentiful options in falling rents. Boise, once celebrated as the success story of modern migration, now stands as one of the clearest examples of a market cooling back to reality. Many local families who stretched their budgets to buy during the surge are now staring at mortgages higher than the value of their homes. Job growth has softened. Out-of-state arrivals have slowed. Even demand for rentals is easing as the market resets. Yet one thing hasn't changed. Idaho is still stunning. Rivers still cut through mountain valleys, forests still stretch toward endless sky, and the natural beauty remains undeniable. But landscapes can't shield an economy from gravity. After soaring higher than almost any other state during the pandemic surge, Idaho's housing market is returning to earth, and the landing isn't gentle. Number 4. Colorado. Colorado has always been a state fueled by vision, a place where people arrive chasing both possibility and wilderness. The Rockies offered adventure. The tech and innovation boom promised a future full of opportunity. For years, Denver, Boulder, and Colorado Springs drew dreamers, engineers, entrepreneurs, and outdoor lovers from every corner of the country. People didn't just move here, they committed to a lifestyle. But heading into 2025, that once perfect balance between excitement and affordability is beginning to fracture. For many residents, the price of calling Colorado home has climbed faster than their paychecks could possibly follow. Housing values surged well beyond wage growth, and the cost of maintaining a home, from taxes to routine expenses, has reached levels that would have been unthinkable just a few years ago. Insurance premiums, particularly in wildfire-exposed areas along the Front Range, have jumped sharply. After multiple harsh winters and repeated energy rate hikes, utility bills have spiked too. Put together, these pressures are pushing households to their limits. Denver's shimmering condo towers, once symbols of a booming urban renaissance, now tell a quieter, more uneasy story. Empty units are becoming more common. Developers are cutting prices, offering incentives, and watching sales slow to a crawl. Remote work, once a driver of growth, has ironically contributed to the softening because suddenly living near downtown isn't a requirement anymore. Across Metro Denver, the housing picture has shifted dramatically. Total listings have surged nearly 50% year over year, and homes are sitting on the market twice as long as they did during the frenzy of the early 2020s. Builders who raced to meet feverish demand during the boom are now tapping the brakes. Construction timelines have stretched, projects are being shelved, and developers are adopting a quieter tone, one that signals caution, replacing confidence. Migration, the engine of Colorado's housing surge, is cooling as well. After more than a decade of strong inflows, the movement has slowed. New arrivals are no longer flooding the state at the same pace, and without that population push, prices are being forced to find equilibrium. Colorado still shines, literally and figuratively. Its natural landscape remains breathtaking, its lifestyle remains magnetic, and its economy remains diverse and dynamic. None of that has changed. But the financial reality of living here has caught up to the people who once viewed it as an attainable dream. Analysts now expect home values across the state to decline 13 to 16% by 2026 if insurance and energy costs continue their upward march. The mountains still glow gold at sunset. The crisp air still whispers freedom. Yet beneath that beauty, the housing market is cooling, and faster than most expected. Number 3. Washington State. For decades, Washington represented relentless progress, a place where innovation wasn't just a buzzword, but the backbone of the economy. The rise of giants like Microsoft, Amazon, and Boeing didn't just shape an industry, they reshaped an entire state. Seattle transformed into a global tech hub, and its housing market became one of the most competitive and expensive in the country. For years, the narrative felt inevitable. Prices would only move up, demand would never fade, and real estate was a guaranteed win. But by 2025, that storyline has shifted dramatically. The change didn't happen overnight. It began subtly, almost quietly. Tech layoffs rippled through major companies, hiring froze, relocation pipelines slowed, big development plans were suddenly paused mid-construction. The machine that once fueled endless growth began to cool, and with it, housing demand started to weaken. In King, Snohomish, and Pierce counties, the effect is unmistakable. Inventory is rising each month, and the frantic bidding wars that once defined the market have disappeared. Homes that would have been snapped up within days are now sitting untouched for weeks, even months. And the financial burden isn't letting up. Property taxes have climbed as counties try to fill budget shortfalls, adding thousands in extra ownership costs every year. Insurance premiums and utility bills have marched higher as well, squeezing even high-income households that once felt insulated. For some longtime residents, downsizing has become a necessity. For others, the exit door, often leading to cheaper states, looks increasingly appealing. The slowdown is even more pronounced outside Seattle's urban core. Suburban areas, places like Bothell, Issaquah, and Gig Harbor, once booming with new builds and incoming families, are now experiencing price drops of up to 15%. Developers have tapped the brakes. Investors are stepping back. First-time buyers are waiting on the sidelines, hoping and needing affordability to return. Washington's economic fundamentals remain solid, but confidence has shifted. The assumption that growth would continue indefinitely has cracked. Today, the market sits in a strange tension. Construction costs are still high, yet demand has cooled dramatically, creating a rare mix of limited supply and sluggish activity. The evergreen state still delivers breathtaking scenery, snow-dusted mountain ranges, deep forests, and waterfront skylines that look like postcards. But beneath that natural beauty, uncertainty is spreading. Industry experts project a statewide home price decline of 15 to 17% by 2026, signaling one of the steepest corrections in the Pacific Northwest. Washington's story is evolving, not because the desire to innovate has faded, but because even the strongest markets eventually collide with the realities of affordability and economic limits. And in this next chapter, the state that once felt unstoppable is learning a new truth. Not even tech-driven growth can defy gravity forever. Number 2. Massachusetts. For years, Massachusetts felt like the definition of housing stability. Its world-class universities, cutting-edge biotech sector, and concentrated pool of highly educated talent made the state almost bulletproof in the real estate world. While other markets cycled through booms and busts, the Bay State consistently stood firm, even thriving through periods of national uncertainty. But by 2025, even this long-standing fortress is beginning to show cracks. Greater Boston, once viewed as one of the most dependable places to build wealth through home ownership, has now become one of the least affordable regions in the entire country. Home values have climbed far beyond what the average middle-class household can realistically handle. Property taxes remain steep, energy costs continue rising, and insurance premiums, especially for aging coastal properties, have surged dramatically. For many families, the dream of planting roots in Massachusetts feels more distant than ever. Ironically, the strengths that once fueled the state's rise are now contributing to the strain. Growth in key sectors, biotech, higher education, and healthcare, has slowed noticeably. Major employers aren't relocating here with the same urgency, and population growth has flattened as more residents look toward states with lower costs and better affordability. Meanwhile, infrastructure that once supported the state's momentum is aging fast. Congested highways, strained public transit, and expensive upgrades are pushing towns and cities to lean heavily on homeowners through higher taxes and rising municipal fees. The financial pressure is mounting across every layer of daily life. In areas like Cambridge, Somerville, and Quincy, the shift is becoming obvious. Condo markets that once felt invincible are cooling, and units that used to sell instantly are now sitting on the market. Investors are stepping back. Buyers who once saw Boston real estate as a guaranteed bet are waiting for prices to adjust. And beyond the city, smaller communities across central and western Massachusetts are wrestling with a different issue: excess supply left behind by speculative building during the pandemic migration boom. Homes aren't moving as quickly, and sellers are being forced to rethink their price expectations. None of this means Massachusetts is collapsing. Far from it. The state still benefits from an elite education pipeline, rich cultural history, and strong professional base. But the era of absolute immunity is gone. Analysts now anticipate a 12 to 15% price correction by 2026, marking a significant shift for a market once considered unshakable. This moment matters not just because prices are adjusting, but because of what it signals. Even the most celebrated high-performing housing markets cannot outrun the combined forces of affordability challenges, slowing migration, and rising costs forever. Massachusetts didn't lose its strengths. It simply reached the edge of what buyers can financially sustain. Number 1. Michigan. Michigan might not be the first place that comes to mind when you think of housing risk, but beneath the surface, the data paints a very different picture. During the pandemic years from 2020 through 2022, the state became an unexpected star. Cities like Grand Rapids, Lansing, and Kalamazoo saw a surge of newcomers escaping sky-high prices on the coasts. Detroit's revival was celebrated nationally, a symbol of resilience and reinvention. Yet as we move through 2025, the mood is shifting. Population growth has not only slowed in many areas, it has stalled entirely. The state's demographic profile is aging, and younger residents are increasingly leaving for warmer climates and stronger job markets. Mid-sized cities that boomed during the remote work wave are now dealing with a very different reality: rising inventory, softer demand, and buyers who suddenly have more choices than sellers would like. In suburban areas around Detroit and throughout western Michigan, homes that once triggered bidding wars are now sitting on the market for months. Listings have climbed roughly 60% compared to last year, and price cuts are becoming routine. What felt like unstoppable momentum just a short time ago is now giving way to hesitation and uncertainty. Michigan's economy, historically anchored by manufacturing, is feeling the strain as well. The auto sector, long the state's heartbeat, is facing layoffs, supply chain realignment, and the unpredictable transition to electric vehicle production. When manufacturing wobbles, Michigan households feel it immediately. Layer on top rising property taxes and steadily climbing insurance premiums, and many families are feeling squeezed from every angle. Some homeowners who stretched financially during the boom are watching their equity evaporate as prices soften. Developers who raced to capitalize on pandemic demand now face half-empty subdivisions and lenders who have suddenly gotten cautious. Access to credit is tightening, refinancing is harder, and upgrades that once felt achievable are being put on hold. Analysts warn Michigan could see home prices slide 20 to 25% by 2026, making it the most vulnerable major state market in the country. This wouldn't just be a correction, it would be a reset. And yet Michigan's spirit remains. The sweeping Great Lakes, dense forests, and deep community pride continue to define the state. The identity is still strong, but the housing market is entering a period of real recalibration. This isn't just a local adjustment. This is a glimpse into how America's heartland might handle aging demographics, shifting industries, and slowing migration in the years ahead. As the dust settles, Michigan may become the case study, the blueprint for the next phase of America's housing cycle. And with that, we conclude our countdown of the top 10 states facing steep home price declines by 2026. From Florida's insurance crisis to Michigan's quiet supply shock, each region carries unique risks that many buyers and investors still underestimate. If you live in one of these states, stay vigilant. If you're looking from the outside, pay attention. Moments of distress often bring opportunity, but they demand caution and awareness. Subscribe to Discover the Cities for deeper breakdowns, city-by-city insight, and real-time analysis of America's shifting housing landscape. Because the next housing downturn may not hit one neighborhood, it may sweep through entire states. Stay informed, stay strategic, and as always, thanks for watching.